Navigating the critical area of unfair trade practices for the national portion of the life insurance exam requires a deep understanding of the ethical and legal standards you must uphold as a licensed producer under state insurance codes and the NAIC Model Law. One of the most common concepts you will encounter is misrepresentation. On the exam, this often appears as a scenario where an agent leads a client to believe that dividends are guaranteed or that a policy is a savings plan rather than life insurance. You must remember that dividends are never guaranteed, and calling a policy a pure investment plan is a major violation that can lead to license revocation. Moving to false advertising, the exam looks for instances where an insurer uses misleading slogans or intentionally omits key facts in a way that creates a deceptive impression for the public. You must be able to distinguish this from defamation, which is the act of making false or maliciously critical statements about the financial condition of a competitor, with the specific intent to injure their reputation or business standing. Another high-stakes area frequently tested is the trio of boycott, coercion, and intimidation. These are often presented through scenarios where a lender refuses to grant a mortgage or a car loan unless the borrower purchases insurance from a specific agency or insurer. This is a classic example of coercion because it restricts the consumer's freedom of choice through force or implied threat. Then we have the concept of unfair discrimination. The biggest trap for students here is thinking that all price differences are illegal. In the insurance world, discrimination is only considered unfair when individuals of the same actuarial class and equal life expectancy are charged different rates without a valid statistical reason. Charging a smoker more than a non-smoker is fair discrimination based on risk, but charging two healthy 30-year-olds different rates because of their race, religion, etc., or national origin is a blatant violation of unfair trade practice laws. Let us focus on the two concepts that students confuse most often, which are twisting and churning. Twisting occurs when an agent uses misrepresentation or an incomplete comparison to persuade a policyholder to drop an existing policy with one company and buy a new one with a different company. Churning, on the other hand, happens when an agent replaces an existing policy with a new one from the same insurer, primarily to generate more commission without providing a real benefit to the client. To keep these straight for your test, use the mental shortcut twisting is out and churning is in. Twisting involves moving the client's business out to another carrier through lies, while churning keeps the business in the same company but replaces the contract unnecessarily. Both are illegal if they are not in the client's best interest or involve deceptive comparisons. Next is rebating. This is the prohibited practice of offering any inducement of value to a prospect that is not specifically stated in the insurance contract. This includes things like sharing your commission, giving expensive gifts, or offering special favors to close a sale. On the exam, look for questions where an agent offers a discount on the first-year premium or a $100 gift card to get the signature. These are clear rebating violations. The exam often tries to trick you by suggesting that a small promotional item, like a branded pen, is a rebate, but the law usually focuses on items of significant value that influence the purchase decision. Finally, remember that the commissioner or director has the power to issue a cease and desist order if they find you are engaging in these practices. If you ignore such an order, the penalties can involve massive fines and the permanent loss of your license. Mastering these definitions and the subtle differences between them is the key to navigating the ethics portion of your national exam.